We on? Okay. So today's cash is zero cash flow and just an introduction on institutional investors. Okay, who knows what a zero cash flow deal is?
A
No?
deal with no cash.
The investor doesn't see any of the actual cash flow from the
Why would they want that?
to keep their kids from taking and spending.
Actually, that is one of the ones that there's two main investors that do well with these, okay? And one of my agents was on the phone and talking about how, great the cash flow was on this property. And the guy says, he goes, I don't want that. He goes, I got a kid that's like, just gonna blow all the money, and I'm gonna, I don't. So as estate planning, he wanted to give his kid some properties, but these zeros are ways that he can give him properties that he's not gonna blow the money because he doesn't see the money. He just sees the appreciation. And then when he wants to sell the property 15, 20 years from now, then
When he has
maybe
a
he'll
little
be
bit
more
more
mature.
longevity.
Yeah.
Okay.
So estate planning is one of them. Another is you have 10 other properties that put off all this cash and you got to pay all these taxes. So anything else you have that has more cash, it's going to be just more taxes. So it's also a way to use tax benefits, and it's also a way to get into properties for a lot lower down payment. Because instead of 20, 30% down, you can get these properties for 7 to 10% down, okay? So let's talk about what they are. It's a structure to take advantage of leverage and depreciation. You can get these properties all the time. You can get them for 85% LTV, but some of them you can get as little as 7 to 10% down because they're very specific, okay? They're a non-recourse loan, and they also have strong equity growth. They're mostly going to be in good markets, and they're going to be bond rated. Okay, so one of the biggest zero cash flow portfolios out there that they're selling right now, that they're pushing, is a bunch of CVS's. Okay, so Chick-fil-A has also done a lot of these, Hobby Lobby. So it's got to be very, very highly rated companies, which I'll go into a little bit more on that too, because that's like a separate class. So basically, someone does these, like, you don't pitch this to everyone, but if someone has a unique situation, or you should at least know about it so that they think you're knowledgeable about commercial real estate, because this is an area of commercial real estate. It's more prevalent with net lease, and a lot of institutional investors, which I'll go into that a little bit, a lot of institutional investors like these because they can buy a lot of properties for a lot more because the leverage is so low, okay? So the strict criteria for these is the property must be leased by investment grade tenant, okay? What does investment grade mean?
National or large regional, I'm guessing.
It could be a franchisor, it could be corporate. It's not always going to be corporate, but usually it's corporate guaranteed, even if it's a franchisee. But it's got to have a certain investment grade, BBB or higher, okay? You guys ever heard of Moody's, Dun & Bradstreet, any of those rating services? Well, the BBB or above is like investment grade, where basically it's almost a fail-safe type of investment. So they grade these companies based on their debt, their income, how much cash they have. Just, the two highest right now is like Microsoft, Exxon, companies like that have billions of dollars in cash. They always pay their bills. There's some of these companies that they have just as good or better bond ratings than the government. Okay, so that's what you're looking at, is that these investment companies, they would rather take a smaller return, but they want safety. They don't want something that's going to be risky. Okay, so it's got to be leased by investment grade tenant. Okay, so think CVS, Chick-fil-A, Hobby Lobby. The base leased has to be at least 20 years or more. Okay, it's got to be absolute triple net bond lease, which means no requirements from the landowner. Everything gets paid for by the tenant. Roof, structure, parking lot, all repairs, all taxes, everything is paid by the tenant, not by the owner. This is a very passive investment for the owner, okay?
The base leases, I mean, initially the lease was 20 years, or there's 20 years remaining on the base lease?
No, normally they're gonna acquire at least like 15 years left, but the base lease, there can be extensions that they can do, but the base lease of the property has to be at least 20 years to get these kind of deals. Now, the rent is paid by the tenant, but it goes directly to the bank. The owner, that's part of the thing with the tax benefits and all that, is the money never goes to the owner. It goes directly to the bank. But that's why the bank is willing to do this with as little as 7 to 10% down, because not only do they have the guarantee of a 20-year lease by a bond-rated company, but they know they're gonna get their money every month directly from the tenant. So CVS is gonna send the money directly to the bank, not to the owner. The owner is just like the one that puts up the 10%, and he's the owner, and he gets the appreciation when he sells, but he doesn't have to worry about taxes during it, and it's a vehicle that doesn't work for everyone, but it's interesting for some people, okay? So that is that in a nutshell. You guys have got a lot more details here, but let me go over a couple of deal stories about how these work, okay? There is a zero transaction as a CVS with the following terms. The initial lease term was 25 years. There's 22 years left on it. It's a fully amortized non-recourse. The interest rate is 7.5. The tenant has a 3-year rent holiday in the last 3 years of the lease. The property may be acquired all cash or as a debt assumption. Property is zero cash flow, absolute net lease, no landlord responsibilities, and they got it for 10% down. So another one here that was, let's see, it was an AT&T office R&D facility. So it doesn't always have to be triple net, as long as the tenant is, AT&T of course is going to be a good tenant to have. But basically they bought a portfolio of 27 locations, and they only had to do 7% down. They're non-recourse, 7% down. So yeah, they all have to fit. And this one only had 10 years remaining on the lease, and it was a foreign investor. So foreign investors like these because they don't have to be paying taxes. Okay, so one of the main buyers for this is institutional investors. So let's talk a little bit about what's the difference between institutional versus retail investors. And just so you guys know, I am going to be doing a separate class next month on the rating systems and commercial credit and all that for institutional. So we'll get into that because that's a totally separate class about how the credit ratings work and what's the difference between AAA and BBB and all that kind of stuff. Now, what would you say is the simplest way to explain the difference between a retail investor and an institutional investor?
Yeah, are we talking institutional who invest in, say, multifamily only, or
No, anything.
anything?
Usually a little more systematic, more experienced, typically not just one or two people, usually a group.
Yeah. When you think institutional, think the very biggest, okay? Think of pension funds, like the California pension fund that has billions that they need to invest. Insurance companies like to invest in real estate, but it's only going to be a small portion of what they invest. But insurance companies, they lend directly to like developers that are building like retail centers, not as much anymore, but a lot of multifamily. But insurance companies are a large investor in properties. Investment banks like Goldman Sachs, hedge funds are also institutional investors. Commercial banks, mutual funds, endowment funds like Stanford, Harvard. Okay, so the main thing to remember between the two is a retail investor is a non-professional individual that pays retail and they pay higher interest rates than institutions. An institutional investor is a person or organization that trades securities or buys properties in large enough quantities to get lower fees, and they also get lower interest rates. They usually invest other people's money, okay? So with these, this is mostly all other people's money that they are managing. Usually with a retail investor, it's their own money, whether it's a partnership or a small investment firm or, just a regular private investor, okay? So it's usually their own money. And a lot of times if they're in multifamily, they're owner-operator. But when you have a institutional, they're usually always going to hire third-party management. Everything is systematic and everything is an algorithm and everything is looked at, but they save money over the private investors because everything is cheaper, okay? So they're the ones that loan out the money to build buildings, or when they do get money, they get money cheaper than other people do. So they can make money based on the spread, the yield. They can, everything is looked at. But when they buy these properties, they always have a investment criteria. So they always, are going to say, well, this is going to be a long-term hold, and after we get, once we've, made X amount over this amount of time, we're going to get rid of it. They're not going to keep an old building that's going to start having a lot of maintenance issues. Okay, they're going to have a algorithm, a computer that's going to tell them, and they're also going to have asset managers and acquisition VPs that are going to let them know when's a good time to sell this. They look at things like when they rehab a property, 18 to 24 months. If I put this much money in, the increase in rent is going to recoup that, and that's how they work. Everything is systematic, and everything is looked at long term. Okay, now working with institutional investors is not something that you can start out with. It's something that you work your way up to. You're normally going to start with your mom and pop, someone that owns a small little apartment building, a small little shopping center. But how would you think that you move up to start working with these institutional investors?
Going to those big meetings, showcases and stuff.
That is one way.
Drinks at the Four Seasons. Meet someone at the bar next to you who's in one of these positions.
Yeah. Well, I've talked about these before, but basically every single industry is going to have these trade shows and conferences and expos. The big one is ICSC. So, they had Recon in Vegas, they had one in San Diego, but they have them all over throughout the year. So that's the big one for retail centers and for shopping centers. So basically everyone that's a owner is a VP of real estate, is an acquisitions director, they're there. So what my agents would always do is that they would register for ICSC. When you register, you get the list of the attendees. And then you can start emailing and calling them and inviting them to meet with you when you're there, okay? So just think about it. These guys have boring jobs. All they do is just sit around and look at spreadsheets all day and decide when they're gonna sell or buy these, whatever. It's not a fun job. They go off to Vegas or San Diego, they're on an expense account. So you meet with them, have some drinks, they get to like you, then you're gonna be one of their guys, okay? So from now on, it's not as hard cold calling because now you got their cell number, you got their, it's an easier working with them. And so it's not working with a doctor or a lawyer or a small time investor on a $5 million building is not any different than working on a 50 or 100 million. It's just the connection, okay? That's all. The transaction's the same, you still go through escrow, you still do an LOI, you can't get intimidated by these guys because basically it's just a bigger building and a bigger sale price. But you have to you have to be in front of those people, and you have to do a certain number of these smaller deals to get their confidence, because basically they're used to dealing with the CBREs and the JLL, and you have to show that you bring something to the table, okay? And so that's why when we sit with them, we should practice beforehand so that you're, competent and confident, but also using all the, the things that we have, like we have our own 1031 company, we have our own finance company, all these things that will help you with credibility when you're before one of these bigger investors, okay? But the main thing that you got to remember with these is they all have a specific criteria, and you can't send them anything that is not within their criteria. We have a big REIT from Japan that we work with, and they had a fund where all they were interested in is ground leases. You send them anything else, they get upset. They're going to go, that's all they were interested in, because that is what they wanted to buy because they're cheaper to get into and they're good long term, blah, blah. They got a new fund where basically they're buying raw land to develop. Okay, so basically it's like you can go on their website, you can talk to your contact, the acquisitions guy, but you got to find out what they're looking for, what area. I mean, there's some multifamily investors, they only want major markets. There's others that they specifically want secondary markets because they want what's called the upside. They want to be able to buy something cheaper that they can put some money into. They want a B building they can put some money into, make it an A building, increase the rent and keep it as a long-term hold, or turn around and sell it and make a few million and then turn that money back into some other properties. Which, when they do that, most of the time, these institutional investors, they're going to use the 1031 because they're not going to pay capital gains. Okay? Smart institutional investors, they will use every single loophole and every single advantage that they can because they don't want to pay any taxes more than they have to. Okay? All right, so anybody have any questions about either one of these?
Are there only certain banks that do the zero cash flow? Or will pretty much anybody do it?
Any bank can do them, but there's some banks that really like them. So there's a couple banks that they love these kind of deals because basically it's not as much risk for them, because I mean the chance of default are minimal because you're dealing with a CVS and you're dealing with a corporate and the money comes directly to them, so there's not even an owner that can hold on to the money and be slow to give to them. So there are a lot of banks that really like those. There's even a lot of investment banks that like to do those deals.
And then since they're non-recourse, can you use retirement funds?
You can. Any other questions? Okay, I'll make this a quick class because we just had 2 meetings right after back to back. So thanks for coming, everybody, and this will be on YouTube if you want to see the video, and all the handouts will be in the Dropbox. So thanks for coming.
Thank you, Craig.
Thank you.
Thank you.